Hi everyone. This week we published an article that talked about how real estate debt is really becoming the new equity in the real estate market. And what we mean by that is typically when you have a hot real estate market, people like to own equity because let's say in 2010 you bought a $5 million home with $1.5 million down, and let's say that this property appreciated to $10 million. So now you have $5 million additional dollars on your equity plus the additional $1.5 million you invested. So that's a huge upside. Versus for the bank that lent you the remainder of that $3.5 million to buy that home, they're still sitting on $3.5 million plus some interest payments. So it's not a great return for them. But if we were going through a down cycle where the prices of real estate was actually depreciating, you would actually be in a better position if you were part of the debt versus the equity. On the previous example, if we had that $5 million home depreciating into $4 million, the buyer would lose about $1 million in their equity. So they would be only sitting on $500,000 in equity. Now that we know it is more beneficial to be on the debt side during a down cycle or during times where market is pretty steady, it is important to know what kind of funds are being raised. So we've noticed that the smart money is shifting more towards debt-like funds versus private equity funds that invest in equity. That shows that smart money believes that there will be some slowing down in the general real estate market. That doesn't mean to signal panic, but we think as this is taking place, investors need to be cautious and be more selective in where they invest and what type of investments that they are making. So investments need to be more active versus a passive type of investment. That is the best strategy during this more difficult time.